A photonics company that most institutional investors couldn't have named 18 months ago just displaced a real estate data firm from the Nasdaq-100 index, and the mechanical buying that follows that move is only beginning. Lumentum Holdings closed Monday at $1,053, up 16% in a single session, extending a one-year return of 1,452%. The broader market was not in a charitable mood. Intel fell 10%, AMD slid 5%. The semiconductor tape that had been the market's engine was cooling, and yet the one name accelerating into the sell-off was an optical components maker whose primary product, the optical circuit switch, most retail investors have never seen discussed in an earnings call. The session itself carried multiple competing signals. Inflation data confirmed that the consumer price index rose to 3.8% in April, outpacing wage growth for the first time in 3 years, according to Federal Reserve economists, citing the Iran war's energy shock as the primary driver. Oil briefly crossed $102 per barrel. The Strait of Hormuz disruption, which Saudi Aramco CEO warned may not resolve until 2027, has already redirected capital out of refiners and into anything that doesn't move on a tanker. That flight to stability bid lifted defensive sectors, while chips, which had run parabolic on AI optimism through April, faced their first serious pressure. Cerebras Systems, an AI chip startup targeting NVIDIA's dominance, filed for a $3.5 billion IPO at a $26.6 billion valuation, the same week its closest public peers were selling off. The juxtaposition was sharp. Capital was simultaneously leaving the most liquid chip names and arriving at a private chip entrance offering. That tells you the market is not bearish on AI infrastructure. It is rotating within it. And that rotation is exactly why Lumentum's Nasdaq-100 inclusion is not a footnote. It is the clearest evidence of where that rotation is landing. Lumentum reported fiscal third-quarter revenue of $808.4 million, up 65% year-over-year. Non-GAAP operating margin reached 25.2%, a 1,700 basis point expansion. The company guided fourth-quarter revenue to $960 million to $1.01 billion, crushing the $917 million street consensus. Operating margin for the next quarter is guided to 35 to 36%. That is not a company on the edge of overheating. That is a company whose customers are ordering faster than it can ship. The $400 million optical circuit switch backlog is fully committed through calendar 2027, and the company acknowledges it is undershipping demand by 30% because manufacturing capacity cannot expand fast enough. That supply constraint in a market that just repriced NVIDIA and AMD lower on demand uncertainty should carry a very specific implication.
The mechanism behind Lumentum's repricing is not about earnings beats. It is about what hyperscalers discovered when GPU clusters started hitting the speed limit of copper interconnects. At AI training scale, hundreds of thousands of GPUs operating in parallel, the bottleneck is no longer the chip. It is the signal path between chips. Copper wiring, which has served data centers for decades, dissipates heat and loses signal integrity at the speeds that frontier AI models now require. Optical circuit switches replace those copper paths with LITE, cutting latency and power draw simultaneously. NVIDIA signed a $2 billion strategic partnership with Lumentum specifically to integrate optical components into its next-generation data center architecture. That partnership is not a procurement agreement. It is NVIDIA acknowledging that its own GPU roadmap depends on someone else's glass. The capital implication is what the Index Committee confirmed Monday. Optical components are now infrastructure, not periphery. When Nasdaq replaced CoStar Group, a real estate analytics firm, with Lumentum in the Nasdaq-100, the mathematical consequence was immediate. Every index fund and ETF benchmarked to the Nasdaq-100 must now hold LITE shares. That is not discretionary buying. That is forced demand, and the market priced it within hours. The 16% single-session gain understates the structural shift. Index inclusion does not reverse. Once a stock enters the Nasdaq-100, passive capital anchors there regardless of subsequent price moves. What the optical infrastructure thesis does not yet account for is concentration risk. Lumentum's backlog is anchored to a small number of hyperscalers. CEO Michael Hurlston confirmed on the earnings call that co-packaged optics, the next-generation product after optical circuit switches, will begin shipping in the first half of calendar 2027. That is the successor product that extends the revenue runway. But 2027 is a year away, and between now and then, one hyperscaler's CapEx slowdown changes the demand picture entirely. The $400 million backlog is contractual, but contracts have renegotiation clauses. If the AI infrastructure spend cycle stalls, the same concern that weighed on Intel and AMD today, Lumentum's undershipping story becomes a different story, a company with locked-in customers who are reconsidering the size of their orders. The question the index inclusion forces is whether forced passive buying has pulled forward 2 years of price appreciation into a single year, leaving the stock exposed to the moment active sellers decide the index effect is complete. That question connects directly to the NVIDIA partnership structure. If NVIDIA's data center revenue, which drove the GPU supercycle, holds above the $35 billion quarterly run rate it printed in fiscal 2026, then Lumentum's 2027 co-packaged optics ramp enters a market with active demand. If NVIDIA's data center revenue softens below $30 billion on any single print, the optical ramp timeline becomes a liability rather than an asset, because the contracts that created the $400 million backlog were written against a specific AI capex trajectory. The historical parallel most directly applicable is Ciena Corporation in 2000. Ciena was the dominant optical networking company during the first internet build-out, with a backlog that analysts called impossible to exhaust. Revenue was real. Contracts were real. Then enterprise and carrier customers simultaneously reconsidered the pace of their fiber deployments, and the backlog that looked like a moat became an overhang. Ciena fell 97% from peak. The current situation differs in one meaningful way. The demand source is not speculative bandwidth. AI model training and inference are already generating revenue for the hyperscalers, paying for the infrastructure. The optical spend is downstream of products that are already sold. That distinction matters when drawing the analogy, but it does not eliminate the cycle risk it identifies. The inflation data released this week adds a second variable. The Fed, which has kept rates above 5% as energy prices from the Iran war pushed CPI to 3.8%, is now facing the same dynamic it managed in 2022, a supply-side inflation shock competing with a still active technology investment cycle. BofA's latest note dropped a blunt warning that rate cuts are not on the table in the near term. If the rate environment forces hyperscalers to discount their forward capex plans, not cancel them, but slow the pace, Lumentum's 2027 shipment schedule shifts from locked in to contingent. The verification benchmark is specific. Lumentum's Q4 earnings report, expected in August 2026, will disclose whether the co-packaged optics order scheduled for first half 2027 has converted from a letter of intent to a purchase order. A purchase order is a different instrument. It carries financial penalties for cancellation. If August's disclosure names a purchase order rather than a partnership agreement, the 2027 ramp is structurally protected. If it remains a partnership agreement, the Ciena parallel has more room to apply. What would prove the current thesis wrong is not a demand slowdown. It is a Lumentum disclosure that the backlog conversion rate to binding orders has declined even as revenue continues to grow. Growth and commitment can diverge. The market has not yet been forced to price that possibility. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.